So ways to build credit, and the best 5 ways to build credit. And this is coming from someone who at the age of 19 has put things in perspective, is in a very good range of credit, I'll say that. So the number one way, and the obvious way, is payment history. That makes up 35% of your overall credit. So in other words, just pay all your bills on time. Your utilities, your rent, insurance, everything. Everything that could be reported to the credit bureaus, even stuff that's not, make sure you pay it on time. Because what that shows lenders is that you're able to pay your bills on time and that you're a trustworthy borrower. And that makes up 35% of your credit. If you guys miss a payment, your credit score will drop at least 60 points or something like that. But that's the most important way. That's the biggest factor in your credit score, is to pay your bills on time and pay everything on time. Try to have 0 missed payments. Try to have 0 late payments. And number 2, keep your credit utilization low. They say to keep it under 30%, but to get the best scores, to get the highest score possible, keep it between 5 and 10%. Only use somewhere between 1% and 8% of my available credit. And that's how I'm able to get such a very good score, to say the least. Because what happens is, if you're on the verge of maxing out your credit, that will show lenders that, wow, he's using a lot of credit. And even then, it shows them that you have to live on credit. It shows them that maybe this person is doing bad financially and he has to put everything on credit. That shows a potential risk to the lender, and that makes up 30% of your credit. So keep your credit utilization low, because that's important. And a lot of people don't know that, because that makes up 30% of your credit score. Amount owed is what they would call it. But keeping your credit utilization low, that's so important. For example, if your credit limit is $1,000, 10% of that is $100. So use up to $100 that paid off in full in each month to avoid interest. Because people start to get in trouble when they miss payments. And as a result of them missing payments, that will dip their credit score. And I can also get into credit card debt. I also talk about credit card debt a lot on this channel, because it's very bad debt. Credit card usage, A-okay, but credit card debt, no way. No way for credit card debt. And that's not what this video is about, but that's a topic that I talk about, and I will continue to make videos about that, because credit card debt in America is crazy, to say the least. And number 3, length of credit history. This is something that I'm still working on, just to be fully transparent, because it hasn't even been a year yet since I opened my credit, since I started using credit. It hasn't even been a year. But also it comes with length of credit history is keeping your oldest accounts open. Even after you pay them off, keep them open. Because if you don't, that will disappear. That credit card will disappear, and that will drop your length of history. And that makes up 15% of your credit score. So it's not gonna impact it like how amount owed and payment history will impact it, but it could still impact it. So try to keep your oldest accounts open. That's basically what that means when they say length of credit history. I mean, if you're going to open credit, keep them open, especially if it's revolving credit, like a credit card or something like that. Just keep them open. You don't even have to use them. Just keep them open. If you do use them, Use them like one time. Just buy a snack at the gas station or something and pay that off. And the fourth way would be credit mix. Lenders like to see not only revolving credit, but installment credit, like student loans, mortgages, credit cards, and auto loans, things of that nature. You guys already know how I feel about auto loans, so don't do that because they're bad debt. Because you don't want to take on bad debt just to show lenders that you could pay back debt. To me, that's silly. If I would do that, I would just do revolving credit and maybe a student loan, if you're going to school or something like that, and a mortgage, because those debts are good debts. Student loans and mortgages, because with the student loan, you're essentially investing in yourself in order for yourself to make more money in the future by acquiring some type of skills, some type of skills, or even getting a degree, so you could get paid more money in the field that you studied for and that you took out loans for. And with a mortgage, with a house, with a mortgage, homes typically, they go up in value, they appreciate. So that's a way that you could leverage your money, because that's a lot what investors do when they invest in real estate. They're leveraging their money at times. And number 5, and this will be the last point, new credit. Basically what new credit is, a financial advisor told me you don't want to apply for too many lines of credit at one time, because usually with that, they're going to perform a credit check. A credit check is usually a hard pull on your credit. Anytime a lender has to pull your credit, has to check your credit score will usually dip. But it's not a huge dip. You can get it back up if you manage that line of credit wisely by paying it on time if it's installment credit, and if it's revolving credit, keeping it low, keeping it open, and paying it off in time in full each month. And what I mean by revolving credit, when I say revolving credit, I normally mean a credit card in most instances. So don't apply for too much credit all at one time. Spread it out every 6 months. Only if you need to apply for credit, because what happens is, if you keep applying for credit all at once, it shows lenders that you're in a financial struggle, and why they need all these credit cards, why they need all these lines of credit all at one time. That's what it shows lenders. So yeah, guys, build that credit score, because credit is important. Because the higher credit score you have, the more money that you will save in interest over the lifetime of your loan.